We're always told to chase the highest returns, right? Make our money work as hard as it possibly can. But what if the single most powerful move for your financial future isn't about growth at all? Today, we're going to dig into why building a foundation of stability isn't just a boring defensive play, it's the actual launch pad for long-term success.
I want you to really think about this for a second. We spend so much time and energy and brain power chasing growth, trying to maximize our returns. But when life throws a real curveball, a true crisis, do those numbers on a screen actually matter in that moment?
And the blunt answer is no, they don't. When you're staring down a sudden job loss or a massive medical bill, a 20% gain in your portfolio is not going to pay the rent tomorrow. In a real emergency, the rules of the game just completely change.
And that leads us right into what I call the return trap. It's this obsession with making money grow as fast as possible, often without us realizing how fragile that strategy can be on its own. When you hear people talk about investing, these are the usual suspects, right? Stocks, crypto, other high-growth assets. They're exciting, they've got huge potential, and honestly, they dominate the conversation. But they all share one critical trait. They're built for the long haul, not for your immediate needs.
And this really gets to a massive difference. The difference between wealth on paper and cash in hand. In a true emergency, you don't need your net worth to go up. You need access to money, like right now, without paying some crazy penalty and definitely without having to worry if the market is up or down that day.
So, this is what happens when those growth-focused plans of ours slam right into messy, unpredictable reality. Because, as we all know, emergencies have absolutely terrible, terrible timing.
Think about it. A job loss doesn't politely wait for the stock market to have a good year. A medical crisis doesn't check in to see if your portfolio is down 30%. Reality demands cash, and it demands it now, no matter what your pretty long-term charts look like.
So what's the answer here? It's not about giving up on growth completely, not at all. It's about building something else first. We need to kind of redefine the whole purpose of the very first dollars we manage to save, and that purpose is to build a financial safety net. And that safety net has a pretty specific name, the emergency fund. And it's not a complicated idea, really. It's just a pile of cash set aside for one job and one job only, to handle the unexpected.
The standard guideline, and it's a good one, is 3 to 6 months of your essential living expenses. And listen, this isn't your fun money budget. This is what you need to cover your housing, your food, utilities, the absolute must-haves. This number is breathing room. It's the runway you give yourself to solve a big problem without having to create a bunch of new ones.
And this is where we have to totally reframe how we think about this money. An emergency fund is not an investment, it's insurance. Its goal isn't growth, it's stability. Its whole purpose isn't to build your wealth, but to absorb the financial shocks of life so that your actual wealth-building assets don't have to.
This right here is the whole mindset shift. You have to get comfortable with the fact that this money is probably going to lose a little bit to inflation over time, and that is okay. You aren't paying it to perform, you're paying it to just be there, calm, ready, and waiting for when you need it most. That's its entire job.
Okay, so let's get into one of the most powerful things this safety net does. It's not just about protecting you from the market, it's actually about protecting you from yourself.
So without that cash buffer, a really dangerous downward spiral can kick in. The emergency strikes. You're forced to sell investments to get cash, and it's very likely happening when the market's already down. So you don't just sell, you lock in permanent losses, totally destroying your long-term plan just to survive the short term.
An emergency fund is the circuit breaker. It's what stops that destructive chain reaction. It stops the panic, it prevents the forced sell, it lets you deal with the actual emergency using cash, leaving your long-term investments completely untouched so they can recover and keep on growing.
And this brings us full circle to maybe the most important idea of all. That boring pile of cash doesn't just sit there doing nothing. It is actively fueling your ability to build real, lasting wealth. It's kind of surprising, isn't it?
See, the true power of an emergency fund is that it acts like a bodyguard for your growth engines. It lets your stocks, your retirement accounts, all of those things just stay invested through the good times and the bad. It lets the magic of compounding do its work over decades without being interrupted. And please, let's not underestimate this point. When markets are crashing and the news is just filled with fear, knowing you have a 6-month cushion is like a superpower. That psychological calm lets you make rational decisions, or even better, no decisions at all, when everyone else around you is panicking. That peace of mind is absolutely priceless.
At the end of the day, it all really boils down to this. You can have the most brilliant, data-driven, genius investment strategy ever created, but if it can't survive a real-world emergency, it's basically worthless. Because life will always happen.
So, what's the key takeaway from all this? The path to long-term success isn't about just blindly taking risks. It's about building that foundation of stability first. Create your safety net. And then, and only then, can you truly invest for the long term, not from a place of hope or fear, but from a position of unshakable strength.